They didn't just sell silver. They yanked the floor out from under the entire world, watched everyone tumble into the abyss, and then quietly, methodically, bought the rug back at the lowest possible price while the dust was still choking the retail investors. If you think that sounds dramatic, good, because what happened over the last few days was nothing short of a financial execution. It was a calculated, brutal, and mechanical dismantling of the psychological resolve of millions of people. And if you are watching this, you are standing in the aftermath. You are looking at the red ink on your portfolio. You are feeling that distinct punch in the gut that comes from watching a fortune evaporate in hours. And you are asking the question that every victim of a hustle asks: what just happened? We need to have a conversation that goes far beyond the headlines. The official story is tidy. It is wrapped in a neat little bow. They will tell you that a surprise shift in central bank leadership expectations spooked the markets. They will tell you that the dollar moved and therefore metals reacted. They will tell you it was a natural correction. But that version of events ignores a chain of coincidences so precise, so timely, and so devastatingly effective that when you stack them together, it starts to look less like chaos and more like choreography. I am going to lay out the anatomy of this crash in a way that the mainstream financial press never will, because they are part of the distraction. I am going to show you the mechanisms behind the move so that you don't get emotionally farmed by the people who view you as nothing more than liquidity. To understand this crash, you have to understand the stakes. We are not just talking about a bad day at the stock market. We are talking about a battle for the control of the only asset that threatens the legitimacy of the fiat currency system. Silver is the Achilles heel of the debt-based economy. It is the truth teller. And when the truth gets too loud, when the price goes parabolic and starts to wake up the masses, the system has an immune response. What we witnessed was that immune response kicking in. It was the empire striking back. But here's the secret they don't want you to know. The immune response costs them energy. It costs them ammunition. And every time they use it, they make the underlying condition, the physical shortage, worse. Let's begin with the weapon of choice, the tool that turned a normal pullback into a waterfall. That tool is margin. Most people think they understand margin, but they don't understand the violence of it. In the futures markets, most participants are not paying the full price for their position. They are putting up a fraction of it, a good faith deposit. This is called leverage. It allows you to control a massive amount of silver with a small amount of cash. It is a powerful tool when the market is going your way, but it is a death trap when the rules change, and the rules did change. Right as the market was heating up, right as the public was piling in, the exchange raised the margin requirements. Think about what that means. It is like driving on a highway at 100 miles an hour and suddenly the speed limit is dropped to 30 and the police are behind you with their lights on. You can't just slow down gradually. You have to slam on the brakes. In market terms, slamming on the brakes means posting more cash immediately. If you don't have the cash, the broker doesn't ask you nicely to sell. They sell for you. They liquidate your position at any price. This creates a forced seller. A forced seller is the most vulnerable creature in the financial ecosystem. They have no agency. They have no choice. They are food for the predators. Now, imagine thousands of traders, all crowded into the same trade, all maxed out on leverage, all receiving that margin call at the exact same moment. The first wave of selling pushes the price down. This drop in price lowers the value of everyone else's collateral. That triggers the second wave of margin calls, which pushes the price down further, which triggers the third wave. It is a cascade. It is a nuclear chain reaction of liquidation, and once it starts, technical support levels don't matter. Moving averages don't matter. Fundamentals don't matter. The only thing that matters is the desperate hunt for liquidity. This was an engineered flush. I use that word carefully. I am not saying there is a group of men in a smoke-filled room laughing at you, although there might be. I am saying that the structure of the market allows for this to happen, and the big players know how to trigger it. The timing was suspicious. The hard shove happened right when liquidity was thinnest. It happened when a big chunk of global traders were away from their screens for the weekend. That is not an accident. Thin liquidity makes big moves easier. If you want to crash a market, you don't do it on a Tuesday morning when everyone is watching. You do it in the twilight hours. You do it when the defenders are asleep. And then, like a match tossed into gasoline, the headline "Risk Hit." The news about the central bank leadership provided the narrative cover. It gave the algorithms a reason to sell. It gave the talking heads a script to read. But the news was just the spark. The fuel was the leverage, and the oxygen was the margin hike. When you combine those three elements, you get an explosion. You get a crash that looks like the end of the world, but is actually just a resetting of the board. But who benefited? This is the question you must ask if you want to survive. Who was on the other side of those sell orders? When the retail trader was panic selling at the bottom, who was buying? It wasn't the other retail traders. They were too scared. It was the institutions. It was the bullion banks. It was the smart money. They were sitting there with their buckets out, catching the falling knives that you dropped. They watched you build the price up. They watched you get overextended. They pulled the rug. And then they bought your silver back from you at a discount. They fleeced you. And they are going to sell it back to you when the price goes to $200. This is the cycle of wealth transfer. It happens in every bull market. The volatility is the price of admission. The market is designed to shake you off. It is a wild horse. It kicks, it jumps, it tries to throw you into the dirt. If you let go, you lose. If you hold on, you win. But holding on when the ground is rushing up to meet you requires a level of conviction that most people simply do not possess. Conviction comes from understanding the difference between price and value. This is the core concept that separates the victims from the victors. The price of silver crashed this weekend. The value of silver did not. Did the chemical properties of silver change on Friday? Did it stop being the most conductive metal in the universe? Did the solar panels on your roof stop working? Did the medical industry stop needing it for sterilization? Did the military stop needing it for missiles? No. The physical reality of silver remained absolute. The demand drivers are structural. They are based on physics, on geology, on the inevitable march of technology. The price, however, is a derivative. It is a number on a screen derived from the trading of paper contracts. It is a fiction. It is a vote. And the vote can be manipulated. When you see the price crash, you are seeing a manipulation of the vote, not a change in the reality. The solar industry is projected to consume over 1 billion ounces of silver in the coming years. That demand is inelastic. They cannot substitute it easily. They cannot print it. They have to buy it. And they will buy it whether the price is $20 or $200. So, when the paper market crashes, it creates a massive disconnect. It puts the physical metal on sale. The industrial buyers know this. The sovereign wealth funds know this. China knows this. While you were looking at the red chart and feeling sick, China was looking at the discount and feeling greedy. They are using these slams to drain the West of its physical inventory. They are trading their paper dollars for real resources. Every time you sell your silver because of a paper crash, you are effectively shipping your wealth to Shanghai. You are aiding and abetting the transfer of global power from west to east. Let's go deeper into the psychology of the crash, because that is where the real damage is done. The financial elite know that human beings are emotional creatures. We are wired to feel the pain of loss twice as intensely as the pleasure of gain. They use this biology against us. They engineer volatility to trigger our fight or flight response. When the market crashes, your brain screams at you to sell. It tells you to stop the pain. It tells you to run to safety. This is a survival instinct that served us well on the savannah when we were running from lions, but it destroys us in the financial markets. They want you to be emotional. They want you to be reactive. They want you to stare at the 1-minute chart and hyperventilate, because an emotional investor is a predictable investor, and a predictable investor is a profitable victim. The only way to defeat this psychological warfare is to zoom out. You have to stop looking at the 1-minute chart and start looking at the 10-year chart. You have to stop looking at the price and start looking at the fundamentals. The debt is still $36 trillion. The deficits are still $2 trillion a year. The inflation is still eating away at the currency. Nothing has changed except the sentiment of the tourists. The tourists are the people who arrived late to the party. They saw the green candles and they chased the momentum. They didn't do the research. They didn't understand the thesis. They just wanted to get rich quick. These are the weak hands. And the market hates weak hands. It shakes them out ruthlessly. This crash was a cleansing. It was a purge. It washed out the speculators, the gamblers, the people who were renting the metal instead of owning it. Now that they are gone, the market is lighter. It is cleaner. The leverage overhang is gone. The foundation is stronger. This is why I say that the crash was bullish. I know that sounds insane. How can a massive drop in price be bullish? Because it reset the positioning. It removed the froth. It allowed the long-term holders to accumulate more. It transferred the inventory from shaky hands to diamond hands. A bull market that is built on leverage is a house of cards. A bull market that is built on accumulation and physical possession is a fortress. We just tore down the house of cards so we could build the fortress. But there is a darker aspect to this plan, a reason why they needed to push the price down now. We are approaching a critical delivery window. The futures market operates on a calendar. Contracts expire. When they expire, the holder has to decide, take delivery of the metal or roll the contract over. If the price is skyrocketing, if confidence in the system is collapsing, more and more people will stand for delivery. They will want the metal. The COMEX does not have enough metal to cover all the paper claims. If everyone stood for delivery, the exchange would default, the game would end, the curtain would fall. So they had to smash the price. They had to make the long position look painful. They had to scare the contract holders into rolling over or selling. By crashing the price, they reduced the incentive to take delivery. They saved the exchange from a default. They bought themselves another month, another cycle. They kicked the can down the road, but the road is running out. They can only play this card so many times before the physical shortage becomes undeniable. We are seeing signs of stress in the plumbing. The backwardation in the futures curve, where the spot price is higher than the future price, is a signal that the market is screaming for immediate metal. The premiums on physical coins are staying high, even as the spot price falls. This is the market telling you that the paper price is a lie. If silver is $70 on the screen, but you can't buy it for less than $100 in the shop, then the price is $100. The screen is a hallucination. The shop is reality. This divergence is the real plan. They want to keep the paper price suppressed for as long as possible to allow the insiders to accumulate physical metal at a discount. They know the revaluation is coming. They know the currency reset is inevitable. They want to own the lifeboats before they let the ship sink. They are suppressing the price to fill their own vaults, and they are using your fear to do it. They are tricking you into selling them your insurance policy right before the hurricane hits. Don't let them do it. Don't fall for the trap. The crash was a test. It was a test of your conviction. Why did you buy silver in the first place? Did you buy it to trade a chart? Or did you buy it to protect yourself from the collapse of a mathematically doomed fiat currency system? If you bought it for protection, then the price in dollars is irrelevant. An ounce is still an ounce. The weight hasn't changed. The history hasn't changed. The future hasn't changed. The seller's regret that is going to flood the market in the coming weeks will be palpable. The people who panic sold at the bottom are going to watch the price rip back up. They are going to see the recovery, and they are going to chase it. They will buy back in at a higher price, locking in their losses and paying the spread again. This is how the middle class is destroyed. They buy high and sell low over and over again, driven by media narratives and emotional impulses. You have to be different. You have to be a contrarian. You have to do the uncomfortable thing. When the market is crashing, you have to buy. When the market is euphoric, you have to sit on your hands. You have to ignore the noise. You have to be cold. You have to be mechanical. You have to act like a bank, not like a gambler. The plan moving forward is simple. Recognize that volatility is not risk, it is opportunity. Volatility is the market breathing. It inhales and it exhales. Right now, it is exhaling. This is the time to take a breath yourself. Assess your position. Are you over-leveraged? If this crash kept you up at night, you have too much risk. Reduce your size until you can sleep, but do not sell your core position. Do not sell your insurance. We are in the early innings of a commodity supercycle. These cycles last for a decade or more. They are driven by chronic underinvestment in supply and structural shifts in demand. We haven't built enough mines. We haven't found enough ore. And now the world wants to electrify everything. The math is simple. Supply is down, demand is up. Price must rise. It is a law of nature. No amount of paper manipulation can stop it forever. They can delay it, they can distort it, but they cannot stop it. The great silver crash of 2026 will be a blip on the long-term chart. 10 years from now, you will have to squint to see it, but you will remember how it felt. You will remember the fear, and you will remember whether you stood your ground or whether you folded. This is the forge. This is where diamond hands are made. They are not made when the price is going up. They are made when the price is going down. They are made in the fire. So look at the crash for what it is, a gift, a chance to buy the most undervalued asset on the planet at a price that shouldn't exist, a chance to lower your cost basis, a chance to steal the metal from the bankers who are trying to steal it from you. The narrative about the central bank leadership is just a story. It is a distraction. The real story is the plumbing. The real story is the flow of metal from west to east, from weak hands to strong hands, from paper to physical. The plan was to shake you out. The plan was to steal your position. The plan was to reset the board so they could play another round. Do not give them the satisfaction. Hold the line. The truth is on your side. Physics is on your side. History is on your side. The only thing against you is your own fear. Conquer that and you conquer the market. The rug pull was violent, yes, but we are still standing. And now that the rug is gone, we can see the floor, and the floor is solid. It is built on industrial necessity and monetary failure. It is a floor that cannot be broken. Stay focused, stay disciplined, and remember, the game is rigged, but that doesn't mean you can't win. You just have to know the rules better than they do. And the number one rule is, if you don't hold it, you don't own it. And if you do hold it, never let them scare you into selling it. The real plan is accumulation, theirs and yours. It is a race for the finite, a race for the real, and the starting gun just went off again. Run the race, don't look back. The finish line is financial freedom, and the only way to get there is to run through the fire.